Chart of the week, bond yields going down. As alluded to in the section on treasuries in our latest report, one impact of weakening growth outlook would be relief for bonds. So just for reference, our base case is a sharp global recession headed into early 2023. We're looking at 18 different leading indicators, and they cover different regions, different time frames, different types of factors, and they're all unanimous in their direction of saying that recession is on the way in 2023. But just looking at this chart here, the latest developed markets flash manufacturing PMI, and so that's the Purchasing Managers Index, which is a really good real-time gauge of the economic pulse, dropped further into contractionary territory in November, and that's a clear indication that the economic slowdown is already underway. And just briefly, the reason why I use the developed markets manufacturing PMI, not just the US PMI for this chart, is that if we look at the other parts of developed markets, so especially Europe and Japan, they've been very much active in quantitative easing or asset purchase programs, and so changes in the economic pulse for those places as well are going to impact on global flows in the bond market, vis-a-vis the quantitative easing by those central banks. But anyway, going back to the chart here, if we take the chart below, this here chart of bond yields literally, it's basically pointing to the US 10-year Treasury yield dropping back below 1.5%, which would be more than a halving from the current level. I do wonder though, if it ends up a little bit more like the closing of that previous gap there. So you can see that big divergence opened up where the PMI took off on the back of stimulus, and it took a while for bond yields to kind of catch up. Part of that was sort of a repression of yields via the quantitative easing or asset purchases, and so there was kind of excess demand for treasuries at that time. And so, and actually it was about this time of the year last year that we're outlining the case for upside risk to yields, not just with this chart, but with a bunch of different indicators that we were looking at the time. And now most of those indicators have actually come full circles. And so in other words, we may be looking at potentially a delayed reaction in this chart for bond yields to catch down to the currently collapsing PMI, but it does really depend on how the economy evolves over the coming months. This chart with the drop in the PMIs is anything to go off, and all the different leading indicators that are pointing, sharply lower into early next year, then maybe it would actually be a little bit faster this time around in terms of closing that gap. And that brings me to the last point. The one thing that I am certain of for all this is that if we do get a proper full-blown recession, traditional kind of recession, triggered by tightening, all the rest of it, bonds are going to perform well in absolute terms in that kind of environment, and they'll actually will perform their usual diversification role of, stock market goes down, bond market goes up, and kind of offset each other just a little bit, will help to mitigate some of the downside versus just 100% equities. And that's, in stark contrast to this year where both stocks and bonds fell through most of the year. And as things stand at the minute, bonds have actually chalked up deeper or steeper year-to-date losses versus stocks. And, it's often the case in markets that when you get the rubber band pulled in one direction, it snaps back the other direction thereafter, and with stocks underperforming bonds on that time frame, quite likely that actually flips headed into next year, especially if this eventuality comes to pass, because one of the other issues is that weaker economy leads to weaker earnings, and that's obviously bad for the stock market. Good for bonds, bad for stocks. So key point there overall is basically bond yields are likely to fall further in the event of a proper quote-unquote recession. So if you found this chart of the week interesting, definitely subscribe to the channel, like, share, comment, and I'll also post a link to the source if you want to go and check that out, and subscribe actually to the chart of the week as well.